Okay, folks, while we're waiting for people to come from the other room, here's what's going to happen. Ka- Kasha and Eleanor, the TAs, are going to take the quizzes up to my office. And folks, quiz is done. Talking about it is not going to make a change. Right? They're going to take the quizzes up. No, it's on. The people are just talking too so loud. I kind of won't help. Okay. So they'll take the quizzes up to my room and they will sort them alphabetically by last name and leave it on my desk. I've already had two quizzes today. I'm first in, first out. So I'm going to do my corporate finance quiz first. Then I'll do the. Could you ask her to just. Hey. Hey. You would? So I will get to your quiz last in the pile, but it'll be sooner than you think. So I'll grade your quizzes. And when they're graded, could we please stop the conversations on the side? I know you want to talk about the quiz, but there's a time and a place for it. This isn't the time and the place. Okay? So I will grade the quizzes, and when they're graded, you will get an email from me saying your quizzes are done. Come and get them. They will be in alphabetical order. Remember, I asked you to write your name on the back. If you did not, I will write your name for you. So hopefully 200 of you didn't miss. So it's a lot. They'll be face down in alphabetical order. Pick up your quiz, and when that email comes, I'll also send you the Excel spreadsheet containing the solution with a grading template. So basically, you can check to see whether there's something that I've missed, and it's entirely possible because I have 600 quizzes to grade tonight, tomorrow. So there will be things I miss, especially as I get more tired. So if you let me know what I've missed, the only thing is it's a one-way fix, which is you will let me know the things that you deserve credit for that I've missed. I don't think you're going to let me know the mistakes that you might have made that I may miss, but that's okay. I accept that as part of the consequence. But let me know if there's something that I've missed and I can adjust the grade quickly. So wait for that email. It'll come at some point in time, and the quizzes will be, I'll let you know where to pick them up, exactly the physical location. So today I want to continue and complete our discussion of the terminal value. Okay. So Jake, remind me again why we put a cap on the growth rate and the terminal value at the risk-free rate. So let's say, I mean, because you're going to get out there. Many of you some of you might do valuation. You're going to an investment banking group. There's going to be a Wharton grad there. There's going to be a Harvard grad there. There's going to be a Michigan grad there, and you're in the group. And they're going to come up with this. I think everybody accepts the rule that the growth rate can't exceed the growth rate of the economy. That's a simple one to accept. Right? It's a mathematical. If you have somebody in the group who doesn't even get that rule, they really don't belong in the group, but you have no power over that. You're stuck with an idiot in your group and you got to kind of keep it. But the second rule of the risk-free rate being the cap for the a proxy for that nominal growth rate in the economy is a messier one, right? I started on it, and some of you might or might not have been convinced. So Jake, get me started. Why is the risk-free rate a good proxy for the nominal growth rate in the economy? See, I didn't even convince Jake. He's trying to think. There's no good reason. Huh? Go ahead. Perfect. So the first is an economic argument, which is in the long term, real interest rates and real growth rates are going to converge. Because if they don't, you'll have an economy which is imbalanced. And because they're going to converge, the risk free rate becomes a proxy for the nominal growth rate. The second is an empirical argument, which is if you look across time and you look at the level of the T bond rate and you look at the level of nominal growth rate, the two clearly move together, right? Look at the 60s, the 70s, the 80s, and especially the last decade, where interest rates were low, but so was inflation and real growth. Turns out that over time, and this is a purely empirical argument, the risk free rate does a pretty good job of being a predictor of nominal growth in the economy. Which also explains why European risk free rates and Japanese risk free rates have been so low, right? Especially Japan. Risk free rates have been low for 30 years. What is it about Japan that makes risk free rates low? Go back inflation and real growth. Inflation has been low, but what is it about Japan that keeps real growth so depressed? It's demographics, right? You have an aging population. Something to think about as you go forward because there are other countries that are, South Korea, for instance, now, is a shrinking population, an aging population. It's tough to have real growth when half the people in the country are over the age of 65. The bigger scare, of course, is China, right? That tipping point, if it happens, is going to create some real growth effects. So the second argument is, hey, even if you don't buy into that real interest rate being equal to the real growth rate, it does a pretty good job of forecasting, a much better job than what's the alternative? If you don't use the risk-free rate as a proxy for the nominal growth rate in the economy, how else are you going to get it? You're going to have to ask some macroeconomists what they think real growth in the economy or nominal growth will be. Not now, but 10 years from now. Fat lot of good that's going to do you because there's almost no chance they're going to give you an answer you can use. Let's say that doesn't work either. I'll give you my third argument. Even if you don't buy into either of these arguments, there's a consistency argument. Let me explain. There are two places this number enters into your valuation, this number being the risk-free rate. First, it enters in your discount rate. So if your risk-free rates are low, what do you do to your discount rates? You also lower them. If you don't set your growth rate at a number that is close to the risk-free rate, and risk-free rates decrease as they did in the last decade. Let's say you continue to use the growth rates you used to use in the 2005, 2007, or even was in the 1980s. So using 3 to 4% growth rates, and you continue to use that, and your risk-free rate has now dropped to 1%. Play it out. What's going to happen? Your discount rates are going to be low. Your growth rates are going to be 3, 4, 5% because that's what you used to use. Your values are going to explode because you've mismatched your discount rate to your growth rate. So even if the first two arguments don't work, there's a reason why you want to tie the two because it prevents your valuations from imploding. Let me give you an example. You've heard of Heineken, right? Most of you probably. How many of you are over the age of 21? I will assume the rest of you have never had a beer in your life. Okay? But when you get to the age of beer drinking, Heineken is one of the best known brands in the world. So about September of 2019, I valued Heineken. It's a Dutch brewery. And I valued the company in euros. Why? Because I wanted to. The numbers are all in euros. I could have done it in a different currency. But see the risk-free rate in euros at the time? Minus 0.5%. Put in the negative risk-free rate. You come up with a cost of capital. That's a tiny number, 5%. This is good news, right? And normally when risk-free rates become low, the analysts say, well, my valuations are going to explode. Let's see if that happens in the Heineken valuation. So I left the risk-free rate at a negative number, came up with a really low cost of capital. Then I turned to my cash flows. I have to live in the same world that my negative risk-free rate is coming from, right? And what's that world? A world of low inflation and low real growth. So when I projected the growth for Heineken, I projected a growth rate of 3.22% a year, and I was being upbeat because it's a mature company in a slowing economy, and I'm doing my valuation in a deflationary currency. So I gave them a low growth rate. Three people from from the Heineken finance group are in the audience, and they didn't like the growth rate, but they kind of let it go. And then I get to my terminal value. And what's the growth rate I'm assuming in perpetuity, Tyler? My terminal value? No, take a look again. What's in front of them? It's first, it's 0.5%, and there's a minus in front of it. I'm following my own rule. Risk-free rate is negative. And these three people popped out of their seats. Said, "That's so unfair. You're giving us a negative growth rate in perpetuity." And I said, "You didn't complain when I gave you a really low cost of capital, did you? What one hand gives you, the other hand takes away." Even with a negative risk-free rate, the value that I got was well below the stock price. What I'm trying to say is dispense with this notion that when risk-free rates get low, your valuations are all going to get higher if you stay consistent. And that's part of the reason I want you to tie the growth rate to the risk-free rate. Your valuations will never blow up. Heineken is just not a good company. I don't like it. Just because the risk-free rate is negative doesn't mean I should find it undervalued. This allows me to do it. Conversely, if you're valuing a Turkish company, remember what the risk-free rate looked like? 15%, 18%. You put that in, you come up with a really high discount rate. If I use whatever growth rate I want, 3 to 5% growth, I'll save you the trouble. No Turkish company is ever going to look cheap to you. But that's because you're mismatching what's happening in your cash flows in your discount rates. So cap the growth rate at the risk-free rate and move on, because it's going to save you a whole host of troubles along the way. Second, yeah, go ahead. After remember, the changes are after the fact, right? So after the fact, you look back and the interest rate changed a lot, right? So is this expected interest rate change or act? Because at any point in time, the interest rate is what it is, right? So if I bought a bond that day, it's not at a shifting rate. It's going to be at the 10-year bond rate that day. It's an opportunity cost. If you're saying the rate could be different tomorrow, yes, so will everything else, right? So let's say rates go up tomorrow. It could be because of higher inflation, in which case my growth rates could be because the economy is doing much better than expected. It's not just the rate that is moving on a day-to-day basis, it's everything in your valuation. If, so tomorrow, if you value the company, you can't just change the risk-free rate. If it's changed dramatically, you got to say what else changes. Again, your whatever you do to your discount rate, play it out on all of your cash flow assumptions. Second stop, remember you do this only when you get to stable growth, right? So you're saying, when will that be? Will it be in 3 years, 5 years, 10 years? Let's make a couple of statements that I think are pretty common sense ones. The greater the size of the potential market relative to the size of your company, the more leeway you get to let it grow for a longer period. You have a small grocery store company. Let's say you're valuing Sprouts. Sprouts is a tiny grocery store company in terms of market share. If you give it 30% growth because you have a story for Sprouts growing, I'm going to let you do it if you feel that that's your story, because the market is huge. And even with the 30% growth rate for the next 10 years, Sprouts will go from 0.3% to 2 or 3% market share. Conversely, if you're looking at Volkswagen, in a mature automobile market, the number of cars being sold has become pretty stagnant. More of them might be electric, but you're not selling 20% more cars every year. You have a large market share of a market that's already stagnant, and you put in a 20% growth rate for the next 5 or 10 years. I have some questions. Where's that growth coming from? Who are you getting it from? Maybe you have a great story of Volkswagen taking over the entire global automobile market. Second, and this goes with the first one, small companies, you have more leeway to put in a high growth rate than bigger companies. Scaling up is hard to do, and it catches up with you. Now, if you follow that up, though, remember, it's not growth that creates value, it's earning more than your cost of capital, right? Step back again. Why do you earn more than your cost of capital? Because you have some comparative advantage that you believe you have. So let me make a statement about those comparative advantages. Companies with strong and sustainable competitive advantages can grow for longer while creating value than companies without those advantages. Take a company like Amgen, biotech company. What's its competitive advantage? Or to pharma company? It's a patent. You get legal protection against competition. Sustainable? Yeah, for a long time, as long as they keep the drug pipeline open. So if you're valuing Amgen, you might say, I'm going to give them 15 years of growth. Coca-Cola, brand name, long. So this is where that story part of your analysis comes in. Companies, strong, sustainable competitive advantages can grow for much longer. And if you have a high growth company with strong and sustainable competitive advantages, you now have this potential of letting the growth continue, margins improve, and create value as you grow. Airbnb went public only, what, 4 years ago, November of 2020. What's their competitive advantage? You want to, yeah. Well, in terms of, first they have a platform, right? First, if you want to rent an apartment or a house anywhere in the U.S. now, you have only two choices. It used to be that you could do owner to owner rentals. Those days are now done. You either go through Expedia or you go through Airbnb. So have the platform. So that's one competitive advantage everybody has to go through. And if you want to list your apartment to rent, guess what? They have just as much of an advantage because you could try a private listing and try to get somebody to come in. But people are not checking newspapers. There used to be a time you looked at the classified ads. When was the last time any of you looked at a classified ad? Would you even know where to find it? So first is platform. Second is the advantage that gives them is they scale up. They get those competitive advantage of collecting 14%. That's what Airbnb takes off every dollar that you spend on Airbnb for maintaining the platform. Is it sustainable? Depends on what. It's a technological platform. It's sustainable unless the technology somehow shifts and ChatGPT connects you with the renter somewhere. Who knows, that can happen. AI might do it. But it is a sustainable advantage. In contrast, I remember a few years ago when Groupon went public, and people had high hopes about growth, and I know, and I looked at what is Groupon's competitive advantage. They got your email faster than everybody else's, right? How long will that last? It lasted like 15 minutes because after Groupon got listed, you got a bunch of other companies doing exactly that, which is allowing retailers to list and sell surplus stuff at low prices. Groupon's competitive advantage is faded in months rather than in years. So when you look at a company, and you say, how long do it? Third stop, remember again that the big number in your terminal value is what you assume about returns on capital in perpetuity. Okay? This is where the sustainable advantage argument comes in. So just to show you how much that end assumption matters, here's what I've done. I've taken a company which basically is in steady state. So you're in stable growth and effectively computed the terminal value with a combination of two assumptions, growth rate forever and a return on capital in perpetuity. Let's say this company's cost of capital is 10%. Return on capital is 10%. I can change the growth rate from 0% to 3%. My terminal value stays exactly the same. You take the same company, give it an 8% return on capital. You change the growth rate, the terminal value actually decreases as the growth rate goes up. If you give it a 12% return on capital, it increases. Now, my book came out in the late 1980s. My first valuation book, it came out from John Wiley was my publisher. It was published at exactly the same time that McKinsey published its valuation book. And we at that time, at least, those were the only two books on valuation. And the McKinsey book on valuation was written by two people who worked at McKinsey, and so both our books were used fairly widely. And the big difference in the McKinsey book is they had a terminal value equation. And here's what they had as terminal value. No plat, which is after tax operating income in the numerator, divided by cost of capital. There was no growth rate. So the longest time I'd get emails from people reading the book saying, I'm reading the McKinsey book, I'm in the terminal value section, I have this terminal value equation. Why is there no growth in the terminal value? To which my response usually was, why are you writing to me? Write to McKinsey. But they thought because we had the same publisher, we kind of hung out together, I don't know where, and talked to each other all the time about valuation. But do you know why McKinsey's valuation book, there is no G in the denominator? What happens to the growth rate if the return capital is equal to the cost of capital? It doesn't matter, right? Might as well use a 0% growth rate. And McKinsey actually explicitly assumed that if you were a mature company in stable growth, that you could not earn more than your cost of capital. Yeah, you can see, right, in the long term, comparative advantages fade. The only problem is putting it in year 10 basically means every company, your Coca Cola and your Groupon, will look exactly the same because they're all required to. I think it's too rigid. But if you make that assumption, you don't need growth in your equation. It's actually a good message to deliver. Right? When analysts get caught up in should my growth rate be 3 or 4%, my question is, what kind of business are you in? Are you in a business well above your cost of capital? In which case, we should spend time talking about it. But if you're in a fairly neutral business where you roughly earn your cost of capital, who cares what the growth rate is? Might as well use a zero growth rate. You get exactly the same terminal value. So let's review. The growth rate cannot exceed. So when you think about projecting growth, it cannot exceed the growth rate of the economy. We use the risk-free rate. The big assumption is your return on capital assumption. And in fact, McKinsey in their own research undercut what they wrote in the book. So McKinsey actually publishes a journal called McKinsey Quarterly. Those of you, it's free. So basically, if you go and register on their site, I'd strongly recommend you do. They actually, this publication, they use their own internal data that they have from clients, the data they've collected over decades of having companies as their clients. And the research basically looks at what they found. So one of the graphs they have in that research shows you what happens to revenue growth at companies over time. So as they get bigger, as you can see, the revenue growth drops off. It converges on the growth rate of the economy. So that's the good news, right? You can put them in terminal value. They also track what happens to returns on capital over time. And what they find is companies that survive a long time, many of them are able to maintain returns on capital above their cost of capital for decades. And what are they assuming? They're assuming that every company in year 10 earns its cost of capital. Growth rate doesn't matter. I don't know how many of you have actually done valuations in your internships, but there are valuations that people do in terminal value where they make a combination of assumptions that essentially get them into trouble. Let's see what those assumptions are. First, they will assume that their company is in stable growth. It's a mature company. So far, so good. They'll give it a growth rate of 2% a year, less than the risk-free rate. Still good, right? And then they will say mature companies, capex offsets depreciation. What does that mean? Net capex is zero. Working capital needs are negligible. Change in working capital is zero. The risk of sounding incredibly stupid. What's 0 plus 0? 0. So the reinvestment is 0. And then they will do that in the terminal value. These valuations, that terminal value is just on the verge of implosion. Here's why. If your reinvestment rate is 0 in steady state, what's the only growth rate you can use? You should be using a 0 growth rate. But they use a 2% growth rate. Because this is what they've always done. So if you run into discounted cash flow valuation, that terminal value, that combination, that combination cannot live because it's internally inconsistent. I usually don't talk about the quiz because it does create angst and then you're beating yourself up. But there was a problem where I asked you for free cash flow to the firm, right? There are two components to it that were a little tricky. One is you've been a firm that had been around only 1 year and had lost money in the last year. Is expected to make money next year. Why is that relevant? Because it does affect your taxes. Why did I have to tell you it's been around only 1 year? Because it's been around more years and I have to give you more information about the NOL because it's been around only 1 year. That loss becomes. The other was I gave you no information about capex and depreciation and working capital, right? So how did he get free cash flow to the firm without that information? What do you do, Sophia? Ah, okay, invested capital, right? What? So let's say you do capex. Where does it go? Thinking, no, we don't think like accountants, but capex goes into the balance sheet as an asset, right? It pushes up your book equity or book debt depending on how you funded it. It goes into invested capital. What happens when you have depreciation? It comes out of invested capital. What happens if your working capital increases? It goes in invested capital. I know I talked about it indirectly when I did the, but every reinvestment is your delta in invested capital, right? So you take the change in invested capital. There's no more need for assumptions. That is your net capex plus change in working capital plus acquisitions plus R&D because that is the shift. And that's basically what we're looking for here. You put in growth, I need to see a reinvestment. Otherwise, what happens? Your invested capital stays frozen. Your operating income rises 2% a year every year. What's going to happen to your return on capital over time? If you have the same invested capital, your operating income keeps rising, your return on invested capital is going to go to infinity and beyond because it just doesn't make sense. And finally, be internally consistent. When you put your company into stable growth, you are bringing the growth rate down. That's the bad news. At least give it the characteristics of a mature company. What will those include? First, if you have a company right now with a beta of 2.5, it's a risky company. Okay, that makes sense. You're a risky, high growth company. But in your spreadsheet, what are you doing? You're making it into a mature company, which is money making and positive cash flows. Its beta should start to move towards 1. Why? Because that's the average beta across all companies. Your cost of capital is 14% to begin with. Okay, I can live with that if you're a risky company. But if you still leave it at 14% and make this company a mature company, you are going to undervalue the company because you're not being internally consistent. I'm listening to your story and trying to make sure that the numbers you're using reflect your story. So if you tell me your company goes from high growth to low growth, low margins to high margins, I'll go along. But then I want to see a cost of capital that shifts down. Maybe even your return on capital start to move towards your cost of capital. So when you look at your terminal value should reflect the story you're telling about the company, not today, but 10 years out. So when you look at my Tesla valuation, my Tesla numbers in year 10 are not the Tesla of today. They're a very different Tesla. One of my biggest issues with valuation is people will change the growth rate, but everything else about the company remains like it is today. That's a mismatch. Your story is at war with itself, and your valuation can't stand up. So, any questions on the terminal values? So, let's summarize the rules in terminal value. Tell me what the basic rules are. So, when you're coming to year 10, what are some of the things you're checking? What's your first stop? Your terminal value calculation. What are some of the things you're checking on? No, no. So all of those go into the equation. But what do you? So let's say you're looking at my discounted cash flow valuation. You're checking the terminal value equation. Take input by input and tell me what checks you're running. Let's start with the growth rate. What's the first check you run? Just compare to your risk-free rate and see if I'm using a growth rate less than the risk-free rate. First stop done. Second stop, you look at the cost of capital. What are you checking there? Well, is it changed over time? So if you start with the 15%, did you bring it down? So the cost of capital changing over time. You get to the cash flow. You're looking for reinvestment, right? You want to make sure the reinvestment rate I'm using reflects the 2% growth rate I have in year 10, not the 20% growth rate I have today. Go input by input to make sure your terminal value. No. Because if you don't, your terminal value can take off with your valuation, and all the hard work you put to get your free cash for the next 10 years has gone to waste. So I'm going to send you the practice webcast for this month is actually a terminal value checker. It's a little Excel spreadsheet. You can take the terminal value numbers, put it in, and it says, this doesn't make sense. This doesn't connect. I won't fix it for you, but I'd say this doesn't make sense. Do you want to change it? So last piece of just the intrinsic value puzzle. We've talked about a lot of ways you can do discounted cash flow valuation, right? You can discount different kinds of cash flows, dividends, free cash flow, equity, free cash flow of the firm. You can choose different discount rates, cost of equity, cost of capital. You can have high growth valuations, or you can have mature growth valuations. You're saying, how do I pick which cash flow to discount, which discount rate to choose, and what growth pattern to adopt? So think of this essentially like a Lego box. You're trying to decide which Lego pieces to bring together. Let's start with the first one. Which cash flow should I discount? You could go lazy and use the dividend discount model, right? Because every company, there is a dividend number. When would you use the dividend discount model? When you get really desperate and you cannot estimate free cash flows at all. What kinds of companies would that be? How many of you are doing financial service companies? Okay. Estimating free cash flow, at least at this stage, is going to be messy because capex, depreciation, working capital all fall together. We use the dividend discount model not because we want to, but because we have no choice. So when you think about dividend discount models, they kind of hang in with those companies because you can't estimate cash flows. In general, if you get to that first branch, equity valuation or firm valuation, in general, equity valuation models are more restrictive than firm valuation models because they require you to make assumptions. In fact, even to get free cash flow at equity, if you remember all those line items had to forecast capex, depreciation, working capital, debt issued, debt repaid, you're going to be pulling your hair out. Free cash flow at equity is easier if you assume a constant debt ratio. Remember the Disney case I used to. So if you have a stable leverage firm, a firm where the debt ratio is set right now and it'll never change, do equity valuation. Everywhere else, value the entire business. In most of your valuations, I expect to see firm valuations rather than equity valuations because it's very unusual to find a firm which has a debt ratio. Say, okay, I can stick with that debt ratio. Now, as to cash flows or dividends, with dividends, you're doing it because you're desperate. You can't, no. And you can value a bank which doesn't pay dividends with the dividend discount model. Sound like a weird thing to say? How would I value a bank with no dividends with the dividend discount model? And but you, in fact, you make a growth assumption. Remember, return on equity assumption. In fact, you would estimate a payout ratio, which right now is zero, but as the growth in this bank levels off or becomes lower, you're going to be. This is the advantage of revisiting assumptions: is you can use a dividend discount model for a non-dividend paying bank by forecasting out what the payout ratio will be in year one, year two, year three, and as your growth comes down, your payout ratio is going to kick up, and you can value the bank. Yes, Jake. No, no, wait, tell me. So let's play it out. So in a bank, let's go through the free cash flow equity calculation. What is the number it starts with? Free cash flow? Net income. Can I get that for a bank? Yeah. Okay. Let's go next line item. What's the next line item? Okay, let's pause there. What depreciation are you going to find in a bank income statement? Almost nothing, right? Almost nothing. Real estate doesn't depreciate. It's land, and most, the building depreciates very little. So what about capex? What about working capital? Some level, everything is working capital, right? But it includes things like repurchases on both sides. You're getting really mixed up as to what it is. You very quickly start to give up. So you can try, but at least the way we compute free cash flow at other firms doesn't work for banks. A little later in this class, I'm going to talk about perhaps a creative way of coming up with free cash flow equity for a bank. But the traditional definition of free cash flow equity is just run into a brick wall. So you use dividends in companies where you really can't, you've given up. You really don't know what the free cash flow equity is. There's not enough information. That's the only thing you're given. Use a free cash flow equity model, but you do it only when the leverage is stable, because if it's not, it's a real mess to compute. It's not that it's not wrong, it's just really the pragmatic choice, too much work. Now, once you pick the cash flow, though, the discount rate picks itself. If you decide to discount dividends, your discount rate has to be, at this point, it should be almost second nature. Which discount rate do you use if you discount dividends? Come on, you just finished the quiz. This is problem one on every quiz, right? It should be the cost of equity. In fact, while we're here, we might as well ask that question you saw on the quiz. What if your cash flows are risk-free? What did you use as the cost of capital for your risk-free piece? Which is, why do you use the risk-free rate? Right? So you think what? You need the cost of capital for the 60% that they sell to businesses. You know what? You're saying this is such a made-up example. You value Palantir. Palantir gets revenues from the Defense Department. It also gets revenues from commercial establishments. Very similar to this example, right? On a much bigger scale. The discount rate used on a cash flow should reflect the risk in the cash flows. Risk-free, the risk-free rate. Right? What currency should you use for the discount rate, Sophia? Use for the cash flows, right? See, already with the discount rate, the choices got made when you did the cash flows, because once you chose to use to estimate the cash flows in euros, discount rate has to be in euros. It's in to equity, it's got to be the cost of equity. You say, what about nominal versus real? Again, I'm going to ask you how you got the cash flows. If those are nominal cash flows, which are often the case when you do currencies, the discount rate has to be nominal. The real. So discount rates just have to be matched up to cash flows. Third stop, say, how do I get to terminal value? Because remember, you got to get there. If you have a company that is already a low growth company, it's 2% growth. Can you do the terminal value calculation right off the top and be done? Do you have to forecast 10 years of cash flows? You could, but it'll make no difference. If you don't believe me, take the numbers. Project out cash flows at a 10% growth, 2% growth rate for the next 10 years, and after the 10th year, put in a 2% growth rate forever. Calculate the present value, and then do one stable growth equation today with a 2% growth rate. You will get the same value. If any of you have picked a mature company with a stable growth rate of, with a growth rate of 2.5%, where things have settled in. That's critical as well. Your cost of capital is settled in. You're not going to change your debt ratio. Your valuation will require only three numbers. Your cash flow next year. Already some of you saying maybe I should go choose a different company. If you have a big, stable company, you're already in stable growth. You might have a company where there is some growth left over. You're valuing Levi Strauss. Pretty mature business, right? But there's still some residue of growth. They're not big in Asia yet. Maybe they can convince Asians to wear more jeans. That could create another but it's not going to be 50% growth. It's going to be 5, 6, 7% growth. It's not going to last that long. And if you want to go from 5 to 2%, you can do it at the end of year. That's a two-stage model: growth for a particular period, and then but that cliff of dropping off becomes much more problematic if you have a 40% growth rate or a 50% growth rate, right? You don't go from 50 to 2. So this is just common sense. You create a transition period to get from 50 to 2. The simple Ginzu spreadsheet that I sent you will work for any three firms. Basically, it's malleable enough, but basically it allows your growth rate to transition over time. So I wasn't kidding when I said this is like Lego blocks. Every discounted cash flow model that you will ever run into there will have a combination of cash flows, discount rates, and a growth pattern. And I can create 100 different variants. Doesn't make them 100 different ways of valuing companies. They just reflect the reality of what your company looks like. And the one thing you cannot do is force different Lego boxes that are not supposed to, Legos that are not supposed to go together to each other. Use a cost of capital with a cash flow to equity. Use dollar cash discount rates with euro cash flows. So as long as you preserve that principle of consistency, these things are all going to work. So I want you to start thinking about your company valuation, because I know you just finished the quiz, but towards the end of this month, you get that one time. I know most of you haven't actually started valuing your company yet. Maybe some of you haven't even picked your company yet, and you just lied to me about this. Hey, pick a company, start working on that, because things are only going to start jamming up together as you go through. So take that spreadsheet that I sent you. Now actually start a base case valuation this evening. It could be a first run, and you can always come back and review and adjust and adapt. Okay. So I will see you on Wednesday, and we will continue our discussion of the rest of valuation now that we've got the mechanics nailed down.
acquisition of companies specifically based on the diversified investment research and Amazon and trying to build acquisition. It's not to think they don't know, but much of what they know is companies specifically are 100 companies that are always like those.
Oh, what if like other kinds of payment that other industry they have like big benefit from autonomous vehicle.
So when the benefits of the growth for your margin, don't mix up that good story with this number.
So like even if the company is like
Go ahead, keep going.
so even if a company is entering like new market with a higher my mom all of her equities she's like I'm never selling it like I